Welcome to our overview of the business cycle, where economies move through expansion, peak, contraction, and trough phases. In this slide, we'll touch on the key economic indicators: GDP, unemployment, inflation, interest rates, and consumer confidence, and show how they shift across phases, while briefly noting strategic frameworks like scenario planning and resource allocation that help businesses respond to each stage. This slide explores the forces that drive cycles, from monetary and fiscal shocks to innovation waves, inventory dynamics, credit cycles, and expectation feedbacks. These short shocks get converted and amplified by internal propagation mechanisms, producing either sustained expansions or recessions. And it's important to remember that no single theory explains every episode. Interactions between drivers matter most. Here we look at the expansion phase, where GDP, employment, and corporate profits climb, capacity utilization rises, and consumer confidence strengthens. Credit typically becomes more available, inflation creeps up, and policy often stays accommodative early on. As expansion progresses, momentum slows, wage pressures build, and policymakers may begin to shift, signaling that a turning point could be approaching. At the peak, growth hits its maximum, and the economy reaches an inflection point. Labor markets tighten, wage and price pressures intensify, inventories can accumulate, and central banks often move to restrictive settings. The slide highlights how current output and forward-looking indicators can diverge, creating early warning signs that set the stage for an eventual contraction. Understanding contraction means tracing falling aggregate demand, rising unemployment, tightening credit, and delayed policy responses. This slide distinguishes a mild slowdown, short-lived, with minor GDP dips, and quick recoveries from a deep recession with prolonged declines and structural damage. It also shows the vicious feedback loop, where rising joblessness reduces spending, which in turn deepens layoffs and revenue shortfalls. The trough marks the cycle's lowest point and the beginning of recovery signals. Output gaps are widest, inflation pressures ebb, and policy rates often sit near their bottom. The slide emphasizes stabilization steps like liquidation and repricing of excess inventories and distressed assets, leading indicators turning up and renewed confidence that together create conditions for the next expansion. Leading indicators give advance notice of cyclical inflections, with components such as manufacturing new orders, the yield curve slope, building permits, consumer expectations, and average weekly hours. These signals typically turn before peaks and troughs, but they have variable lead times and can produce false alarms. So filtering against broader context and multiple data points is crucial for reliable forecasting. Coincident indicators define current economic performance and help date phases in real time, including non-farm payrolls, real disposable income, industrial production, and retail sales. Combining these volatile series into smooth composite indexes reduces noise and improves trend visibility, and those composite turning points are commonly used by official bodies to mark expansion and recession periods. Lagging indicators confirm what has already happened, rather than predict turns, examples being the unemployment rate, CPI inflation, unit labor costs, and outstanding business loans. These indicators respond late to changing conditions, so while they're valuable for assessing recent performance, relying on them for real-time policy decisions risks poorly timed interventions and potential overcorrection. This slide compares monetary and fiscal tools across the cycle: interest rate cuts, forward guidance and quantitative easing on the monetary side, and automatic stabilizers, discretionary spending and tax relief in fiscal policy. It stresses coordination between policies to mitigate lags and strengthen credibility, since joint action tends to maximize stabilization effects and support a more confident economic recovery. Sector rotation and operational timing are practical ways to align portfolios and businesses with cycle phases, favoring cyclicals like industrials and tech, early in expansion, then shifting toward defensives and cash as late-cycle risks rise. Operationally, firms adjust inventory, staffing, and capital expenditure to match demand signals, while scenario planning and flexible cost structures help manage downside risk and maintain agility. The final slide links phases to asset behavior and strategies. Equities often rally early, commodities peak mid-cycle, bonds and high-quality credit outperform during contraction, and cash, or short-term instruments, protect capital at the trough. Strategic approaches include dynamic rebalancing, global diversification, liquid alternatives, and hedging to exploit cycle-driven mispricings and control drawdowns, while preserving optionality for the next expansion.